Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. Joining me today, Phil Kosmala with Taiber Kosmala. He is the managing partner, chief strategist. Taiber Kosmala has $12 billion assets under management. They work with foundations and pensions and a select group of advisors like myself from around the country. Very happy to have him on. Did I mention foundations? I think I did. I think I got everything in it, Phil. Very happy to have Phil joining us today. Great insights. And Phil, I'm going to get as much out of you as I can while I've got you here, since this is a treat. Let's put up the slide on the executive summary there and talk a little bit about this part with the bear markets. And again, I know reading the tea leaves looking forward, as we've said, the Fed is going to be a big part of that. But share with us what your thoughts are as far as looking forward here.
Yeah, Hank, we spend a lot of time looking at economic analysis for one reason and one reason alone. And that's extremely rare to have a bear market in stocks or a 20% drop in stock prices. That's your Nasdaq going from $100,000 to $80,000 in a very abbreviated period of time. But it's really rare to have that type of bear market or 20% plus drop in stock prices without an accompanying recession.
Right.
In fact, it's only happened 3 times in 80 years. And 2 of those times were the prospect of war in World War III. 1962, Bay of Pigs, Cuban Missile Crisis. We had a booming economy, and you still had stocks drop by 20%. 1966 was the invasion of Hanoi. So markets can get disturbed by the prospect of a war. But basically, as long as you get the economic analysis right and where we're at business cycle, as long as there's not a recession in the cards in the next 6 to 9 months, markets usually do very well. You can always have the 10% correction. Hank, I know you know these numbers and you have them memorized, but for everyone watching today, 10% corrections are very routine in markets. They happen every 15 months. 5% corrections happen 3 times a year, and we just happen to start the year here with one of those 5% type corrections, Hank. And so I think looking at the economic tea leaves, we look at 24 different indicators, and we study those judiciously. We've done that for over 25 years. And when you start to see more than a third of those economic indicators telling you that there's a recession in the cards, these are good leading indicators on a recession. And we'll unpack a few of those in a second, Hank. But as long as those don't flare up, historically, there's been no sign of a recession, and markets have done pretty well if you just simply bought and held. At this point in time, Hank, those indicators are telling us that there's more room to the upside, that the markets probably should mean revert, that we should see good upside potential here. But we do have some risks in front of us that we haven't had to face the last 2 years. Mm-hmm. That includes Federal Reserve tightening monetary policy. That includes some of the geopolitical turmoil with China and Taiwan, with Russia, Ukraine, with Iran in the Middle East. So we do have some things that could potentially disturb the apple cart here in 2022. The weight of the evidence right now, Hank, is telling us that the economy is on pretty good footing. The U.S. consumer is on good footing. Manufacturing, despite all these COVID supply chain issues, the global economy and manufacturing hasn't been this healthy in over a decade.
And this is, this next slide, in fact, the little bell curve here, the Goldilocks, that's kind of what you're describing is where we're at currently.
Yeah, Hank, so normally when you look back in the annals of time, when you've had a couple of these baskets of indicators clicking on all cylinders, you've had very good or above average returns. That's kind of that horizontal line in the middle. Mm-hmm. And we go through each one of those in a little bit of detail, but the most important factor that we can watch as investors is the U.S. consumer. Our U.S. consumer accounts for almost 68% of our economic activity, our $20 trillion economy. 68% of that is the U.S. consumer. That's us going out, spending, going to restaurants, vacations, et cetera, Hank. And so that's mission critical for us. And the U.S. consumer, quite frankly, has never been in better shape. When we look at disposable income and you look at the average income in the United States, and then you compare that, Hank, with monthly payments. So those are credit card payments, mortgage payments or rent payments, and other forms of revolving debt, autos, et cetera. The U.S. consumer has never been in better shape in the history of the country. It's under 10% of disposable income. So you're looking at a U.S. consumer that's in really good shape. They just can't spend. Hank, we talked about this a couple of weeks ago on the show. But right now, the normal number for autos in the United States, those are cars sitting in dealer lots or sitting in manufacturing facilities ready to be distributed. The normal number on that, Hank, is 1.2 1.28 million cars. We're sitting here today at 61,000 cars in the
That's
United
crazy,
States.
isn't it?
So it is. And what is it? That means inflation, right? I think there's too much money chasing too few goods. That's the textbook economic definition of inflation. And I think that's the big risk for this year is how does the Fed judiciously start to drain some of the liquidity, the $12 trillion that we've injected into our financial system in 14 short months that's helped propel, and just to keep that in perspective for everyone, our economy is a $20 billion economy, and we injected $12 trillion, almost 60% worth of GDP was magically conjured out of thin air. Right. That's part of the reason we have some inflation, but it also helps stabilize the global economy in the midst of this pandemic.
This is one which brings us to the fork in the road. You know, this is a great slide with Yogi Berra. And, of course, he famously said, when you come to a fork in the road, take it.
Yeah, so we found a great young picture of Yogi Berra and his Yankee regalia. So this is a favorite of ours, Hank, because I think normally studying economic cycles, what do we know is that almost every recession since World War II and even predating that have been caught by the Fed tightening too much or taking the punch bowl away too quickly. Right. And Federal Reserve is going to have to make a decision this year. We had 7% inflation readings come out. We haven't seen those numbers since 1982. The Fed's going to have to make a decision, Hank. Do we try to pay back this debt that we have, $30 trillion worth of national debt? Do we pay it back with cheaper currency and try to reflate our way out of our problems? That's that left branch in the road, back to Yogi. If that's the case, Hank, the game plan's pretty easy, I think, for us as investors. If the Fed allows inflation to stay hot, they only raise rates 3 or 4 times this year, that would be a very slow tightening process by historical norms. Equity markets have usually at least experienced really good returns in those types of examples, in those types of tightening regimes when the Fed has been very slow in how they've raised rates. Right. When the Federal Reserve quickly raises interest rates, and we have several examples of that in recent history, Hank. That's 1994, the Fed raised rates quickly, 2004 to 2006, and then we had the banking crisis and the great financial crisis. When the Fed goes through a very quick tightening campaign, something usually breaks. And so back to Yogi Berra and our playbook as investors, and we think it's a great time because we study business cycles, and normally you can understand when the business cycle is starting to deteriorate, Hank. You can get defensive. This one's going to be driven by the Fed as opposed to business spending and consumer spending. And I think the two different playbooks are, if we let inflation run hot for a longer period of time, and that's the case, stocks do well, commodities do well, small caps do well. We know that those are the preferred asset classes in a higher inflation environment. Conversely, if the Fed starts to be panicked over inflation, we have a midterm election coming up, and I know we'll talk a little bit more about that, Hank. But if the Fed starts to drain some of this liquidity by raising rates more quickly or more precipitously than what's forecast or what Wall Street expects right now, that's a totally different game plan. That's when you start looking at bonds. Bonds actually outperform. We've seen that routinely over the past 100 years. To see the dollar outperform, and we'll start looking at, you could buy the US dollar currency ETF and things like that. And alternative investments usually do well in that environment, Hank. So 2 completely different playbooks. And this is not a normal cycle. I think after you inject $12 trillion in such a short period of time, how does the Fed drain that? We've never seen it in the history of the country, Hank. They'll write textbooks about this, and our grandkids will study this monetary experiment that we're running right now.
There we go. We know it's not a science; it's an art at best. And right now, that's going to be a big concern. We're going to take another break. When we come back, though, we're going to launch into this one. I love, Phil, the 7 big questions for 2022. How this can help you plan for the new year coming. But first, a break. Join us here. We'll be right back on the Retirement Report.